Welcome back. Today, we're diving into a fascinating clash happening right now in the financial world. It's this massive collision between a traditional, heavy-hitting financial giant and the absolute cutting-edge future of prediction markets. And you know the craziest part? This is so much bigger than a simple boardroom disagreement. It's really about who gets to control the infrastructure of tomorrow's financial data. Let's get right into it.
To really grasp this battle, we've got to start with CME Group. And make no mistake, CME is an absolute powerhouse. Just look at the second quarter of 2026. They raked in a jaw-dropping $1.706 billion in revenue. And get this, $1.353 billion of that came purely from clearing and transaction fees. We're talking about a wildly successful machine sitting right at the beating heart of global finance.
So, that brings us to the core mystery of this explainer. Why in the world is the CEO of this incredibly profitable exchange picking highly public fights over prediction markets? I mean, compared to CME's massive empire, this space is practically tiny right now. Why risk the controversy? Well, to figure that out, we need to peel back the layers of how they actually make their money.
Chapter 1. What does CME actually sell?
Before we can judge their strategy, we've got to understand their core engine. See, CME isn't your average stock exchange. They run massive derivatives markets. We're talking futures and options on basically everything: interest rates, equity indexes, energy, metals, agriculture, foreign exchange, commodities, you name it. And here's their brilliant little secret. CME doesn't care which way the market moves. They don't need to predict if oil or stocks will go up or down. They just provide the playground. They just need people to keep trading. Actually, when markets get volatile, that's when demand spikes for the hedging and risk management services they offer.
And that 64% operating margin shows just how lucrative that setup really is. Out of that $1.7 billion in revenue we just talked about, CME generated roughly $1.1 billion in operating income. Guys, that's an absolutely extraordinary margin. They're seeing an average daily volume of 29.8 million contracts traded. The machine works perfectly, so why chase the whole prediction market trend?
Chapter 2. The $238 million clue.
Turns out the answer isn't necessarily about trading fees. The real turning point in our investigation is buried in another part of their balance sheet. In that exact same quarter, CME reported a record $238 million in market data revenue. That's up 20% year over year. And it tells us something absolutely crucial about the economics of financial information. CME doesn't just make money when people trade. No, they monetize the massive mountains of information generated by those trades. The information is literally just as valuable as the execution itself.
And this is where prediction markets come into play. Think about what they actually produce. They don't just ask, hey, what will happen? They ask, what probability does the market assign to this event happening? This generates unbelievably valuable probability data on all sorts of things: elections, interest rates, inflation, the weather, corporate events. CME wants in. They want to be the infrastructure layer that controls and monetizes this completely new generation of financial probability data.
Chapter 3. The competitor shift.
So CME is definitely not the only one eyeing this prize, and things are moving incredibly fast. Just look at Kalshi. We're watching this really fascinating dual-track evolution unfold. On the one hand, you've got massive retail curiosity, like Kalshi aggressively pushing into consumer engagement by partnering with 5 Major League Baseball teams. Fun, right? But on that exact same platform, we're seeing some very serious institutional infrastructure being built. Wall Street heavyweights like Cantor Fitzgerald have launched prediction market trading for institutional investors, and Susquehanna is out there providing pricing and liquidity. This isn't just retail gambling anymore, folks. Prediction contracts are rapidly morphing into legitimate financial instruments.
Chapter 4. The Regulatory Time Bomb.
Now, as with any shiny new financial instrument, the biggest roadblock isn't the tech, it's the law. Right now, we're in the middle of a fierce jurisdictional tug-of-war. On one side, you have states arguing that some of these prediction contracts look a lot like gaming, so they should fall under state law. That leads to a mess of fragmented rules. I mean, there are nearly 50 pending state actions right now, including New York's legal action against Kalshi, which involves a potential penalty risk reported at roughly $36 billion. For an exchange, state-by-state rules mean skyrocketing costs and a ton of legal uncertainty. But on the flip side, the CFTC is arguing for unified federal oversight under derivatives law. If that unified federal framework wins out, boom, you unlock a massive increase in scale, liquidity, and institutional participation. Ultimately, regulation is going to dictate the size of this entire industry.
Chapter 5. The $1 trillion question. Let's focus on the ultimate prize here, because the forecasts being thrown around are just mind-boggling. Research firm Bernstein predicts this market could hit roughly $1 trillion in annual trading volume by the end of the decade. $1 trillion. But let's pause for a second, because we have to clarify a crucial distinction here. Volume does not equal revenue. Even if a market sees $1 trillion in volume, the real question for investors is how much actual economic value the exchange captures through fees, data monetization, and market maker economics. So CME isn't out here chasing pennies. They are fighting for the highly lucrative infrastructure layer of $1 trillion volume machine.
And they are up against some highly capitalized rivals. Make no mistake, CME isn't just squashing tiny little startups in a corner. This is a multi-billion-dollar cage match. Polymarket was recently seeking a valuation above $20 billion, boasting an annualized revenue that has surpassed $1 billion. Kalshi reportedly reached a valuation of around $22 billion earlier in 2026. This is a total clash of titans, involving traditional exchanges, huge startups, sportsbooks, and brokers all fighting for the exact same piece of the pie.
Chapter 6. CME's Moat versus the Risks.
So does CME actually have a unique advantage here? Well, here's the bull case. They have a nearly impenetrable moat. We're talking massive liquidity, deep institutional relationships, decades of regulatory experience, and a distribution network that's already up and running. They don't have to build any of this from scratch. And honestly, the strongest proof might be this. In Q2 2026, CME provided clients with more than $95 billion in daily margin efficiencies, basically freeing up massive amounts of capital for their clients to deploy elsewhere. That alone shows you just how deeply embedded their clearing infrastructure is within professional finance.
But let's deliberately flip to the bear case, because a great company can still make a bad investment. The execution risks here are very real. You've got ongoing state regulatory risk, plus serious reputation risk if these markets start getting viewed more like gambling than actual finance. Even CME's own CEO raised material manipulation concerns about certain contracts. Add in the fierce competition and the very real possibility of cannibalizing their own existing financial products. And the most crucial point, CME doesn't even need prediction markets to survive. Like we saw earlier, their core business is already wildly profitable without it.
Chapter 7. The Final Investment Verdict.
It's time to strip away all the hype and just look at CME purely as a stock. For the income investors watching, I want to remind you of this number, $1.16 billion. That is exactly what CME returned to shareholders in just the second quarter, through $468 million in dividends and $695 million in stock buybacks. They are an incredibly strong, cash-generating, asset-light business that is rewarding its shareholders today, totally regardless of what happens with prediction markets tomorrow.
Let's synthesize everything we've talked about into a clear, simple scoreboard. The core business, that's a green light. Strong revenue, huge volume. Market data growth, another green light, up 20%. The prediction market opportunity, we'll call that potentially significant, also green. But look closely at the friction points. Regulation is flashing a big red light right now due to major uncertainty at both the state and federal levels. Competition gets a yellow caution light because it's fiercely increasing. And finally, the valuation of the stock itself is a yellow light. It's something that absolutely must be examined carefully.
Which brings us to our final verdict. As a business, CME earns a solid buy quality label. They have huge volumes, fantastic margins, and incredibly high barriers to entry. The whole prediction market opportunity, put that on watch. It's a really exciting option for future growth, but those regulatory dynamics are still totally unresolved. As for the stock, watch or buy on valuation. But above all else, don't buy the hype. That $1 trillion forecast from Bernstein, that's future industry trading volume, not guaranteed revenue dropping into CME's pocket.
I want to leave you with this final, provocative thought. In investing, the best company isn't automatically the best stock. You could buy an incredible financial machine, but if you pay an excessive valuation for it, you can still end up with mediocre returns. We've established CME is a high-quality infrastructure company, but separating the quality of the underlying business from the hype of the market, well, that's your job as an investor. So looking at the data, the moat, and the risks we've explored today, what price makes CME a good investment for your portfolio? Think about that. Keep learning, and thanks for joining me on this explainer.